Welcome to the VFX Podcast, a space where we break down how markets actually work, beyond the headlines, beyond the noise. In each episode, we dive into the mechanics of price action, market structure, and technical analysis, explaining not just what happens in the market, but why it happens. We explore specific concepts, real trading behavior, and the decisions professionals make every day, from risk management to execution, from strategy design to market psychology. This podcast is produced by VFX, where technology and experience meet real market conditions. If you're here to understand the market, not guess it, you're in the right place.
I want to kick things off today with a scenario that, it plays out millions of times a day, probably right now as we speak.
Okay.
You're sitting at your desk, or maybe you're on your phone, you're looking at a stock chart, currency pair, whatever. You see the price move, you decide it's time, and you click buy.
And boom, instantly you see that confirmation. Trade executed.
Right, it's instantaneous.
Yeah.
It feels totally seamless. But here's the question that I think most of us, even those of us who follow the markets, we rarely stop to ask, who is on the other side of that click?
Yeah.
Because for me to buy, someone has to sell. My assumption, and I think it's what most people assume, is that there's another person, let's call him, Bob in New Jersey.
Mm-hmm.
And Bob just happened to click sell at that exact same millisecond.
And it's a comforting thought, isn't it, this idea of a peer-to-peer marketplace? But if you were actually waiting for Bob in New Jersey to match your order, you'd be waiting a long, long time.
Right.
In reality, that liquidity, that ability to buy or sell instantly, it's manufactured. It's a machine.
And that is our mission for this deep dive.
Mm.
We are peeling back the curtain on the plumbing of the financial world.
The hidden years.
Exactly. We want to move you from being just a passive observer of those squiggly lines on a chart to actually understanding the machinery underneath. We're talking market makers, the massive economic weather systems, and how modern tech, AI, crypto is just completely rewriting the rules.
And we have a really robust stack of sources to get us there today. We're looking at some high-level exchange data from the NYSE, some advanced educational stuff on price action, and even documentation on a new algorithmic platform called Vortex VFX.
I'm actually really excited to demystify terms like dark pools and liquidity. They always sound so ominous.
Like something out of a spy novel.
Yeah, exactly. But they're really just the mechanics of how money moves.
They are. And what's vital here is connecting those technical mechanics to your everyday life. Because whether you trade or not, these hidden gears dictate the price of your gas, the value of your retirement account, everything.
Okay, so let's start with that invisible hand we mentioned, the market makers. The research from the NYSE uses a definition, but let's go deeper. When I click buy and Bob isn't there, who's selling to me?
It's a market maker, or an MM. At its core, this is a firm, it could be a huge institution or a really sophisticated algorithmic trading shop that stands ready to both buy and sell an asset at quoted prices. Their whole business is providing liquidity.
Liquidity. That's one of those buzzwords.
Right.
But in this context, it just means immediacy, right? The ability to get in or out fast.
Precisely. Think about it like this. If you want to sell your house, it might take 3 months to find a buyer. That's an illiquid market.
Right.
But if you go to a currency exchange at the airport, they'll take your dollars instantly. They are the market maker. In the stock market, they make sure you're not stuck holding something you want to sell.
But they aren't doing this as a public service. They're making money. The sources talk about earning the spread.
Right. And this is the key. If a stock is trading at, say, $100, the market maker might post a bid to buy it at $100 even, and an offer to sell it at 101 cents.
So $100.01, that 1 cent difference is the spread.
That's the spread.
Which sounds negligible.
On one share, sure. But these firms are processing millions, maybe billions of shares. They capture that penny millions of times a day. But, and this is crucial, they are taking a risk.
Okay, what's the risk?
What if they buy your stock at $100 and before they can flip it, the market crashes to 99? They're left holding the bag.
This brings us to a really critical distinction in the source material. We have the standard electronic market makers, the pure algos, and then the NYSE's designated market makers, the DMMs.
Yeah.
I always just assumed the floor of the NYSE was just, a TV set these days. But these DMMs are still a huge deal.
They're a massive deal. And this is one of the most interesting parts of the market structure. A standard electronic market maker is purely profit-driven, an algorithm. It has no loyalty to the stock. If the market gets incredibly volatile, think the flash crash or early 2020, their risk protocols kick in.
They see the danger and they just pull the plug.
They fade. That's the term. They widen their spreads so much that it's too expensive to trade, or they just stop quoting altogether. They vanish when you need them most.
Because catching a falling knife is bad business.
Exactly. But the DMMs on the NYSE are different. They have what's called a positive obligation. It's a contractual requirement.
An obligation.
Yes. They are physically located on the trading floor, and they must maintain a bid or an offer at the best price available nationally, the NBBO, for a specified percentage of the day.
I saw that stat for S&P 500 stocks. They have to be there, 43% of the day?
That's right. And crucially, they facilitate the opening and closing auctions manually if they have to. This human oversight, combined with that obligation, it acts as a dampener on volatility.
And there's data on this.
There is. The data we looked at showed that during the COVID crash in March 2020, when panic was absolute, stocks that had DMMs showed significantly less degradation in market quality than stocks that didn't.
That's a powerful insight. When the algorithms get scared and run for the hills, the human with the contract has to stand there and buy. It's like a breakwater for the market waves.
It creates friction. And in a crash, a little bit of friction is a very good thing. It slows the descent. But we have to remember the NYSE is just one place. The market today is incredibly fragmented.
Right. This is where we get into things like dark pools.
Yes. A lot of retail orders never even hit the public exchange. They get routed to wholesalers or to these alternative trading systems or ATSs. This means a market maker today has to track their inventory across dozens of these fractured venues instantly. It's a web.
So we have the market makers keeping the gears greased, but they don't decide where the car is going. The actual direction, up or down, that's driven by much bigger forces. Let's zoom out to what you call the macro stage. Who are the players actually moving the price?
You can visualize it as a food chain. At the bottom, you have the retail traders. That's us. The sources note that in the Forex market, retail is maybe 5 to 10% of the turnover.
So, relatively speaking, we're the plankton. We provide some liquidity, but we don't steer the current.
We're along for the ride. The ones creating the waves, those are the institutional investors. The whales.
Pension funds, BlackRock, those guys.
Exactly. When they decide to rebalance a portfolio, they're moving billions of dollars. That volume physically pushes the price.
And above the whales, the referees.
The central banks, the Fed, the ECB, they control the environment the whales swim in. They control the money supply itself.
Okay, this is where we need to unpack the economic weather. The sources list inflation, interest rates, and GDP. I feel like a lot of people see these as just, boring textbook definitions.
Yeah.
But for a trader, these are real, actionable signals.
They're the only signals that matter in the long run. Take interest rates. The Fed raises rates to fight inflation. We all know that. But the nuance is the lag.
The long and variable lags the Fed is always talking about.
Exactly. It's like steering a massive container ship. The Fed hits the brakes today by raising rates, but the economy doesn't feel that whiplash for, say, 12 to 18 months.
So if I'm a smart investor or a market maker, I'm not trading on what the economy is doing today. I'm trading on where I think that ship will be in a year from now.
That is the entire concept of forward guidance. The market is a discounting mechanism. It prices in the future. That's why you might see terrible economic news come out, like unemployment going up, and the stock market rallies.
Because the whales think the bad news will force the Fed to cut rates sooner rather than later.
You've got it. It's a game of four-dimensional chess. And
Right.
then you throw in the wild card. Geopolitics.
The resource map.
The resource map. Geography dictates leverage. Saudi Arabia controls 12% of global oil. Russia, huge gas reserves. But look at text. The Democratic Republic of Congo holds the vast majority of the world's cobalt.
And you cannot build an EV battery or an iPhone without cobalt.
You can't. So when a news alert pops up about a conflict in the Congo, that isn't just a political story. That is a supply shock.
Which hits the charts immediately.
Instantly. The algorithms read the headlines, they anticipate the shortage, and they bid up the price of commodities before you've even finished reading the tweet.
So, okay, we have this chaotic environment. The Fed is moving rates, wars are hitting supply chains, whales are splashing around. How does an individual trader even begin to navigate this without getting crushed?
Well, this brings us to the toolkit. The educational source material focuses really heavily on price action.
I love how they frame this. It says trading isn't guessing, it's interpreting the collective psychology of buyers and sellers.
A price chart is just a record of a battle. Think about a candlestick chart. A single candle tells you who won the war in that specific time frame. Did buyers push the price up and hold it high? Or did sellers smash it back down?
And when you zoom out, you start to see these zones support and resistance. But the source makes a really important point. These aren't magic lines on a chart.
No, and treating them like thin lines is where people get into trouble. They are zones of psychological memory. Support is a floor, a price, where buyers have historically stepped in because they feel the asset is cheap. Resistance is the ceiling.
Where sellers step in to take profit.
Precisely.
Let's talk about execution, because this is where theory hits reality. The difference between market orders and limit orders. For a long time, I just thought a market order was the default button you press.
A market order is essentially saying, get me in right now, I do not care about the price. In a calm market, that's fine. But in a volatile market, one with low liquidity, you pay a kind of desperation tax. Slippage. You might see the price at 100, you click buy, and you get filled at $100.50 because that was the next available seller. You're immediately down.
So the limit order is the patient approach.
A limit order says, I will buy, but only at $100. You might miss the trade if it never comes back down to you, but you control your entry. The pros use limit orders.
And then there's the stop loss. We always hear, use a stop loss for protection. But the sources hint at something a little darker. Liquidity hunting.
This is a crucial concept. If everyone looks at a chart and sees a support level at $100, where do they all put their stop loss?
Right below it, $99.90 or something.
Right. And what is a stop loss? It's a market sell order. So you have a massive cluster of sell orders sitting just below that support line.
Oh.
Institutional algorithms can see that liquidity. They might push the price down just enough to trigger all those stops, grabbing that liquidity for themselves, and then the price reverses and shoots straight up.
So you get stocked out, you take the loss, and then you watch the stock do exactly what you thought it was going to do.
It's not a conspiracy theory. It's just the mechanics of liquidity seeking. The market moves toward liquidity.
That is slightly terrifying, but very good to know. Okay, so we've covered the traditional plumbing. But our final stack of research points to a new evolution, this convergence of AI, retail trading, and crypto.
We're moving from human specialists to algorithmic dominance, and now to what we could call hybrid models. The Vortex VFX materials we looked at are a prime case study of this shift.
So let's look at Vortex. It's pitching itself as this bridge between the institutional power and the retail trader. It mentions AI-driven intelligence combined with expert human oversight.
It's an attempt to solve the reliability problem we talked about. You know, how pure algos can fade or crash. A hybrid model tries to use AI for its speed and pattern recognition, but with human checks and balances to prevent catastrophic errors.
But I have to pause on one number here because it just jumps off the page and screams red flag. The material mentions potential APYs for staking around 88%.
88.7.
Right. My bank gives me, what, 0.5%? How is that even remotely sustainable?
And you should be skeptical. In traditional finance, 88% implies either insane leverage or a Ponzi scheme. But in DeFi, decentralized finance, you have to look at where the yield is coming from. It's not interest from lending.
It's a share of the fees.
Exactly. It's more like a dividend. The source explains their real yield engine. They take a portion of the trading volume revenue, $5 per lot traded, according to the documents, and they pool it. If you hold their token, you're essentially a mini shareholder. You're getting paid from the activity on the platform.
So if trading volume dries up,
Yeah.
the yield dries up.
Correct. It's variable. That high percentage just reflects the current ratio of volume to the size of the liquidity pool. It rewards early adopters, but it carries the risk of the underlying asset, the token itself fluctuating in value.
So you might earn an 88% yield, but if the token drops 90% in value, you're still losing money.
That is the risk. But the utility is interesting. Staking also grants governance rights through a DAO.
A decentralized autonomous organization. So the users get to vote on the platform's rules.
In theory, yes. It sort of democratizes the rules of the game that were previously set only by the exchange owners or the central banks.
And they're trying to close the loop with the real world, too. The VFX crypto card. This seems to be the holy grail for crypto actually being able to spend it.
It addresses the friction problem. Usually, if you make money trading crypto, getting it into your grocery budget is a nightmare of transfers and fees. This card lets users spend those rewards or trading profits directly.
It creates a closed loop. You trade, you earn rebates, you stake for yield, you spend it with the card. No traditional bank needs to be involved.
It's a parallel financial system. And notice the tiered structure, standard versus premium. The more you stake, the higher your rebate on trades. It gamifies providing liquidity.
It really does. It's almost like, remember how we started with the market makers earning the spread? It sounds like these platforms are trying to let the retail trader earn a piece of that action.
That is the crucial observation.
Okay, let's try to synthesize all of this. We started with the designated market maker on the NYSE floor, physically standing there to ensure order. We zoomed out to the central banks, shifting interest rates. We looked at the individual trader fighting battles on a candlestick chart. And now we have these AI-driven, tokenized systems trying to automate and democratize the whole process.
And the common thread through all of it is liquidity. Whether it's a guy in a blue jacket on Wall Street, a server farm in New Jersey, or a DAO-governed AI bot, the goal is the same. Match a buyer and a seller and discover the fair price.
But the walls are coming down.
Drastically. We've moved from a closed club to this open, sometimes chaotic digital ecosystem. The barriers to entry are lower, but the complexity and the need for education is higher than ever.
Which brings us to the big takeaway. For our listener, why does all this matter?
Because the market is a living ecosystem. You can't just look at a chart and see a line going up. You have to see the battle. You have to understand that when the price drops, it might be the Fed, or it might be a DMM holding the line, or it might be an algorithm that just hunted your stop loss.
And here's the thought I want to leave everyone with. It's a bit provocative. We talked about how market makers earn the spread. They're the house. But with platforms like Vortex VFX bringing AI and real yield directly to retail, are we moving toward a future where that line between a market maker and a retail trader just blurs completely?
That is the big question, isn't it?
I mean, if your AI bot is providing liquidity and earning a tiny spread while you sleep, and you're getting rebates from the trading volume, have you just become the very institution you used to trade against?
It's a powerful thought. You might not be fighting the whales anymore. You might be joining the pod.
Something to chew on next time you look at a chart. It's not just data. It's psychology and technology battling it out in real time. Thanks for diving deep with us.
Always a pleasure.